Welcome back to episode 5 of the 1 Million Project Vision 1. So, today I want to talk about a suggestion. I want to suggest a trading plan to you, a trading plan that I use and which should help you and give you some ideas of what you should look for. So, first of all, risk management must stay above everything else. And that also includes emotional management and regulation and just having discipline and patience. Um, for this training plan, I use several accounts for several different risk profiles. I will get to that in a minute. We will definitely only swing trade, which could be with day trading entries, meaning we have a swing perspective, swing targets, but we could definitely enter on a day trading perspective, meaning from the hourly shouldn't enter much lower. Should you enter lower, I would suggest to you that you risk only half of what you would normally risk. For me, it's basically no scalping with scalping entries at all. If I enter with a swing perspective and let's say the market in 1 or 2 hours pushes to the target, that's fine. And obviously that's scalping, but it's not my intention because I intend to enter the market on a swing perspective, and that's what this is about. Now, you should aim at a minimum of 1 to 2 risk to reward ratio, and you should definitely have emotional intelligence, and you should practice this. I will talk about this in a minute. And we also must know when not to trade, as this is as important as to know when to trade, to just sit there and do nothing. And last but not least, I want to talk about the flow state, meaning once you're in this flow, in this area where you just execute your plan, you have this routine, you're looking for setups, you set an alarm, alarm rings, you wait for confirmation, you double check, you enter, you wait, it hits take profit or stop loss. That's basically your stop loss, where you don't get emotional, you have accepted the risk, you have your expectations on point, and the market does whatever it wants. You lock that trade to your journal and on to the next. That's basically it. So let us start with risk management above everything else. So first of all, a break-even day is a good day because first of all, your job is not to make money. Your job is to basically, because that is the wrong mindset and the wrong perspective, your job is to execute a plan. You basically have a structure, you have a plan, and you just follow the process. That's it. And money is the byproduct of this process. So that means it doesn't matter if you win a day, if you're losing a day. It simply doesn't matter because you have tested the strategy. I have tested the strategy, which I'm about to show you. You have your data, you have your statistics, and you simply are executing on what you have learned. And that's it. And risk management is cutting losses when they're getting out of hand. So your plan must have something in place for you to cut losses. For our strategy, it simply should hit stop loss, and that's fine. When we hit take profit, we make double the amount. So I wouldn't cut into this too much, except they're very unexpected news, and it's clear that the market is going against you. Or, and that is the second and the most important step, imagine you have analyzed the markets and you have found your zones and your targets wrong, and you have just realized this while being in the trade, while being negative, and you've just realized this, or price has then broken critical structure which should have supported price but it didn't. So for example, we wanted to buy but price broke lower without hitting the stop yet. Well, if this is the case, then alright, if you were wrong, cut your losses, because then it would be unnecessary, for example, to lose double the amount and go on to the next trade and be patient. That's it. And that is risk management, and it's the most important thing above anything else. And so you must always know where your zones are, your targets, your stop loss, and you must accept the risk. And again, if you're wrong and you realize this, then cut into this and cut the loss. Should it reverse on you, be neutral. Like this can happen, and again, we normally would leave the trade to hit stop loss or take profit, but risk management goes to both sides. So for example, not only for the stop loss, also for the take profit. For example, should you see that we are moving to target, but let's assume you bought and we haven't taken out the next high to the left yet, but we've tapped into an imbalance. And now price is heavily reacting on this imbalance and is basically reversing on you. Then you should at least put the stop to break even in this case, and then either price hits break even or take profit, so at least you have secured the trade, or you can put it below critical structure, slightly in profit. That is up to you. In my opinion, sometimes it makes sense, but you must be objective. You must be statistically objective, and this is why I would suggest you either let the trade hit stop loss or take profit, so you don't play around in between. If you have several accounts, you can do that, but for your main account, I would just suggest yes, that you let the trade play out. And another thing is for the ratio. So let me talk about this first, about the 1-to-2 ratio. Now this is a good expectancy with a fairly high win rate too. You will not always get that, and I would suggest that you don't fuck up the stop loss or take profit placement just for the sake of a 1-to-2. Sometimes you will have more. You will have a 1-to-3, even 1-to-5 in some cases, but sometimes you won't even have a 1-to-2, and that happens. So for that, I would suggest rather play it safe and put your stop loss and take profit to the critical levels that actually make sense, rather than trying to get this 1-to-2 when the market doesn't even care about your placement or ratio. So again, it comes down to perspective. Who are you? You're a small retail trader. It doesn't make sense for you to try and force something. It will go against you, because the market does whatever it needs to do in order to fulfill a target, and it's not a very precise science. It is, the market moves in certain patterns and structures, and it must use liquidity, and for that it could do that in several ways. So rather play it safe and just keep that in mind. Now, I use several accounts for several risk profiles, and the reason for that is simple. High risk is high risk, so there's a big risk of blowing the account. But on the upside, if it works out, then you have a big potential for big winners and you can always withdraw money. Now, for the medium and low risk accounts, again, lower risk of blowing the accounts. It takes more time, but it's also less stress, and yeah, it's a long-term game. Now, with swing trading, um, again, it's pretty clear. So for me, there are certain things that you can keep in mind. So I always start with the weekly, sometimes even with the monthly. And from the weekly, if I see something, which I will show you in a strategy video, you can scale down to the 4-hour time frame, because that gives you a pretty fractal swing view of what to do. You can also go down on the hourly, which is more noise, but still great for that matter. Now, when I start on the daily, which I sometimes do in some cases, then keep the weekly levels and monthly in mind, but scale down to the hourly to look for price to hit its target. Now, what I found is from daily to the hourly, you should be done in a day or two, or maybe three in some cases. Now, when you scale down from the weekly to the 4-hour time frame, your trade will run anywhere between roughly a week to several weeks, sometimes even a month. So you just gotta keep in mind you want that one trade a week. What's it gonna be? Like, is it like, are you big enough yet to play it safe and play those weekly levels, or are you too impatient? Like, whatever it is, keep that in mind. And I wouldn't go lower than the hourly. If you must, the M15, but again, I wouldn't go lower than the M15. For me, the hourly is the sweet spot. Sometimes lower, but try to focus on real swing trades rather than anything else. And if you have the time, again, you can play that intraday, but swing trading, that's for me. Now, emotional intelligence means the emotional discipline, your behavior, that journaling of this, which should be the exercise, um, is as important as risk management and the strategy itself. So I would give, in terms of importance, 1/3 risk management, 1/3 the strategy, and 1/3 emotional intelligence. In fact, I would even place um, emotional intelligence and control over the other two, because, at least for me, that is the most important and hardest thing to master with trading. Yeah, and you should definitely put more focus on yourself than any technical, fundamental aspect, strategy, whatever, because it's that important. And you also have to keep in mind that on a subconscious level and biological level, basically the brain works against you in trading. So basically, I mean, you can do some research on this. I don't want to go too deep in this video, but basically survival instincts get triggered when you lose a trade. It's that hard for the brain to comprehend and accept, and this is why all kinds of toxic behavior is happening. Um, for example, FOMO, and entering after a loss and trying to make it back, like all these things. It's just like your brain goes into survival mode, and that is contra productive for trading, and you have to keep that in mind. Knowing when not to trade is as important as finding a setup, because What is your job as a trader? It's to wait, to be patient, because the market is giving you something when it's fine and ready, and you have to wait for that precise moment, and if you can't, you're out. And since we're not machines, to keep the statistic realistic, you definitely have to put your focus on waiting. It's also very indicative. Um, Basically, in every other profession, in every other job, you get paid by the hour. You get paid for your result. Um, with the difference that the more effort and the more power you put into your work, oftentimes the better the result, the more money you make. With trading, that's not the case. In trading, you have to wait for a setup, sometimes a very long time, and not certainly, but if you follow the plan, you get rewarded and sometimes you lose. And that's the process. So you get paid for the process. Money is a byproduct of a good process in trading. And that's the difference. So your job really is to follow this process no matter what. And all kinds of things, jump into this, like your emotional behavior, like all these things, they just trap you in this behavior. And that is why you have to check on this and you must follow your plan. It doesn't make sense to write a plan and not follow it. So this is what this is about. Now, I will show you the strategy in the next videos, and you should carefully watch this video, but it's not the most important video. I know many of you are waiting for the strategy, but this is just the part of this process. This here is as important. So now, for the trading plan, I will already tell you the details and show it to you in a strategy video. So here's my plan basically. So first of all, you start your day, your session, whenever you have time. For me, that is early in the morning. Wake up at 6 a.m. I check the charts, do some sports. But when I check the charts, I want to look for a few things, and it's always the same process. So first of all, I look at the chart, at my watch list that I have always prepared, and I start with the monthly and weekly time frame, and I look at the trend. We going up or are we going down? A sideways phase, a accumulation phase, is also part of a up or down trend for me. So I look for an up or down trend first. Second step, also on the weekly and the daily, do we have in this process internal liquidity, meaning imbalances where price wasn't efficient? Because we assume that price always comes back to the mean, it needs to be efficient, it needs to take liquidity. Okay, so we mark these internal liquidity levels. I want to look for the extreme level. I don't want to use some in the middle. It doesn't make sense. I want to look for the extreme internal liquidity level that hasn't been mitigated, meaning touched by the market for the first time after it was created. I then set an alarm basically on CTrader, because I can use as many as I want. You can also do it with TradingView. And I wait for price to come into this internal liquidity level. Okay, that's That's the plan until here. Now, my alarm rings, price somewhere came into this internal liquidity level. I now want to wait for price to shift structure. Let's assume we're looking for a buy. So price pushed up, left some imbalance behind. It now comes back. It's basically in a short-term downtrend, in a reversal. And I now want to see a market structure shift back up to the upside, meaning it must break on a lower time frame, could be the 4-hour time frame, the hourly time frame, after it tapped into the internal liquidity level and has stopped at some order block. It must then reverse, and in this case, since we're looking for a buy, it must break the last lower high. I can then look for the same thing. After that break, did we create, now on that break, scaled down, an internal liquidity, so I can even wait for price to come back into this, and even on a lower time frame, wait for another shift. So it's double confirmed, if you know what I mean. You then target the external liquidity, in this case the high, but as explained previously, you keep internal liquidity on the way up to that external in mind should price reverse on you again, and you then manage your risk. And that is basically all you do. This is your trading plan. Now, if this was confusing, if you want to see it visually, wait for the strategy video. I hope that helped you, and see you in the next video.